All right. Well, it is the 11 o'clock hour. Thank you so much for joining us today for a discussion on proposed changes to our actuarial reports for pooled plans. My name's Simone Parker. I'm the Assistant Division Chief here in Stakeholder Relations. We have allotted 45 minutes for the presentation and 15 minutes for questions and answers. If you have a question, you can use the Q&A feature at the bottom of the webinar screen. There's a little button that says Q&A. If you click on that, you can type in your question. We'll try to get to as many questions as time permits. As a reminder, this webinar is being recorded and we will post it to our YouTube channel in about a week. That concludes the housekeeping items that I have for you today. I'm pleased to have our Deputy Chief Actuary, Randy Zubek. Randy joined CalPERS in February 2015. He has worked 30 years as a consulting actuary prior to joining CalPERS. So it's my distinct pleasure to introduce Randy Zubek.
Thank you, Simone. I assume you and everybody else can hear me. Excited to be here today with all of you, and I was very happy to see how many of you were able to register for today's session and join us today. As Simone said, my name is Randy Zubek. I am Deputy Chief Actuary in the CalPERS Actuarial Office, and here today to talk to you about changes in the works with regard to pooled plan actuarial valuations. Now, I think it's important right at the beginning to be specific about which plans exactly we're speaking of here. For the purpose of today's discussion, we're talking only about those public agency plans that are a bit on the smaller side and therefore get placed into one of CalPERS' two risk pools, the miscellaneous risk pool or the safety risk pool. And that's why I assume most of you are here. Now, we are not going to be, for example, talking about the schools pool, which is a completely different entity, different rules, and not at all part of today's discussion. So now the title of this session is an ambiguous changes to the actuarial reports, but I think I can quickly in a nutshell summarize what we're talking about here. What we're planning to do is to take the individual actuarial reports that we currently provide to you all annually and cut that number down by about half. Now, how we're going to do that, why we're thinking this is a better way of presenting results to you, and what this will mean to you as a CalPERS agency, that's what we'll be discussing during the remainder of this session. So let's go ahead to the next slide. And we can move forward. Okay, before we jump into the details, I think there's a few comments I'd like to make that I think it would just be helpful if we all keep these in the back of our head while we're listening to this presentation. First of all, I'm sure among all of you listening today, there's a pretty wide range of your knowledge of how the valuations work for these pooled plans. Even those of you that might consider yourselves sort of a junior actuary or expert in this area, I would expect that you'll hear some things today that you didn't quite understand before. And it's not that you weren't paying attention or that there's any issue with that. These are very complicated and nuanced topics that, quite frankly, you probably didn't need to know all the details. But we're going to go through some of them today because I think they help reinforce the reason why we want to combine some of these reports. Also, very importantly, while we're going to argue today that this is going to be a better process going forward than what we have now, that's not to say that there's been anything inappropriate or unreasonable or incorrect with the process up to this point. We're simply taking an already good process for performing these valuations and attempting to make it just a little bit better. And when we say better, broadly speaking, we believe that through this process, as CalPERS agencies, you will gain a better understanding of your financial commitments to CalPERS, which may then lead you to perhaps better financial management of these plans that better align with your specific objectives. Next slide. So our topics today are going to be a little bit of background about how the pools work, our reasoning for why we think it's important to combine some of these reports. Then we're going to talk about one specific valuation item, the asset numbers that you see within these reports. I think, and this is where the conversation is going to get a little bit technical, a little hard to follow. I'm going to do my best, but I think it's important for us to really talk through specifically what asset values mean in these pooled reports. Then we want to talk about this idea of the importance of seeing the big picture. We'll have some information in that section that will indicate that, we think seeing this information combined more so than it is will be easier for you to manage than seeing the information separately. Then, of course, we'll talk about the specific impacts on you as agencies, and then close out with some final comments. Next slide. Okay, background, we can move ahead a slide. So most of you, I assume you have pooled plans. You probably know the information on this slide, but we established the pools, CalPERS did, in an attempt to minimize the volatility of the year-to-year contribution results for these smaller agencies. It's much more likely for a small group of members that contributions from one year to the next can be very volatile and change quite a bit from year to year. It's much harder for us to predict what is going to happen with a small group of people than with a larger group. So that's the purpose of the risk pools, to share the unexpected experience across the entire pool on an even basis among the pools or the plans within the pool. Now, part of the pooling process, as no doubt you also know, is that for each benefit tier in which you have active members, and that might be a classic formula, 3 at 50, for example, or a Pepper formula, 2 at 62, any benefit formula or benefit tier in which you have active members, we produce a completely separate and independent valuation report for those benefit tiers. Next slide. And if we look across all of the reports that we generate for our agencies every year, we do over 4,100 reports annually, which is one of the reasons it does take us a while to get these valuations done. We're usually a year behind the valuation date because of just the sheer number of reports that we generate. And the vast majority of those are for these pooled plans, over 3,700. Just around 400 of non-pooled plans. Now, these plans, these employers are very much like you. They're cities, they're special districts, they're just a bit larger, and they are valued standalone as a non-pooled plan, as opposed to being in the risk pool. But even though the numbers of reports, are much higher for the pooled plans, if you looked at the size of these plans in terms of assets or payroll, the grouping of non-pooled plans is actually much larger than the risk pools. And then across the bottom row, you can see the breakdown of these valuation reports between the miscellaneous classification versus safety. Next slide. So how are we going to combine these reports exactly? So let's start here. What we're going to do is we're going to look within more broad classifications of members. For example, the miscellaneous classification. So these are any of your folks that are not safety members, right? Their job has nothing to do with like a safety member would have. So within that classification, you may be getting 1, 2, 3, or maybe even more individual valuation reports for that miscellaneous grouping of members that you have. And it's within that group then that we would, going forward, take those individual valuation reports and combine them down to a single report. Now, if we move to the safety category, within the safety category, we generally consider police and fire to be relatively separate and distinct classifications. And so we don't have any plans to take police plans and combine them with fire plans. And certainly we're not combining any miscellaneous plans with any safety plans. Now, the exception to that is going to be If by chance you already have a valuation report that already combines some police members and some fire members, and that could have occurred for a number of reasons. But in that situation where you're already getting reports on a combined basis for police and fire, we will likely take all of your safety plans and combine them into a single report. Otherwise, you're more likely to get one report for your police group and a separate report for your fire group. Now, what will these reports look like? Well, for the most part, every item in the report, just as you see it now, is going to be the total of these benefit tiers added together. So, for example, you used to maybe see 3 different asset values for your 3 different miscellaneous benefit tiers. You will now, going forward, only see one total asset number, which is just the sum of those 3, but you'll see it in total and not separated. Now, the exception to that, what we will continue to show individually is the normal cost percentage for each of your benefit tiers. And we'll talk about why that is on a later slide. Now, as far as some of the other items in the report, we may or may not show them split by benefit tier. Some of that will depend on feedback as a result of this webinar or other stakeholder engagement that we do going forward.
Hey, Randy, sorry to interrupt you. There's
Oh, yeah.
a clarifying question in the chat.
Yeah.
Okay, it says we have miscellaneous classic and miscellaneous classic 2 and a PEPRA. Are you saying that 2 classics would be combined and a PEPRA still separate?
No, I am. What we are saying is that within the miscellaneous category, all of those tiers of members will be combined into a single report. You will not have classic numbers versus PEPRA numbers. And that, by the way, is consistent with what the folks who get non-pooled valuations see. Those bigger agencies, we have always given them a single report that includes both classic and PEPRA. With only a very few number of items do we show separate between classic and PEPRA. One of those being the normal cost, which we will continue to show. And quite honestly, that's probably the most important thing for you to see separated between classic and PEPRA. We all know that the benefits for classic members are a little bit more costly than PEPRA, and that information is relevant. How much more? That question comes up. The normal cost individual percentages that we will continue to give you will be your best indication of the relative costs of those 2 groups of folks.
Thanks, Randy.
Yeah, next slide. Okay, so just to further illustrate what we're talking about, the miscellaneous risk pool, if you think of that as this big blue circle here on this slide, is a very large pool of members and benefits and assets. We perform roughly 2,400 separate valuations for this miscellaneous risk pool every year. And if we were to zero in on one specific agency, this particular agency only has miscellaneous folks, no safety folks. But as the question in the chat had, 3 tiers of benefits: a classic tier 1, a classic tier 2, and PEPRA. And so currently they're getting 3 separate valuation reports. So 3 out of the 2,400 that we do for the entire risk pool. And in each of those reports, they're seeing a separate normal cost percentage and a separate required payment towards their unfunded liability. All 3 reports have unique numbers for those items. Next slide. And once we then perform this combination, our total number of valuations will drop to around 1,100. Now, the size of the risk pool is the same. It's the same people, the same groups of agencies. The size of the pool is not changing. What's changing is the number of reports that we'll issue for these members. And this sample agency now will get a single report. It will continue to show 3 separate normal cost percentages. And when it comes time to make the required contribution for their members, those individual percentages will apply to the payroll for those groups. The big change will be that there will be a single required payment towards unfunded liability. You will not see a separate unfunded liability for classic versus PEPRA. you will see a single unfunded liability, and you will have a single payment towards that unfunded liability. Next slide. Okay, so why do we think it's important to do this? I mean, you might think, well, it certainly is less administrative effort to generate fewer reports, but that was not at all the reason for wanting to do this. And we're going to try to make that case in this section. Next slide. Okay, so I think I would classify the reasons in three main categories that we have on this particular slide. First of all, we believe, and we're going to try to demonstrate, that certain information within your reports is just more useful to you as sponsoring agencies on a combined basis than seeing them separately. Secondly, also a very important point, some of these items that we're separating currently, and I've used the term artificial here, and in a sense, these are somewhat artificial separations because they don't really lead to any difference in the funding of the plans, the financial reporting of the plans, and just providing those in valuation reports perhaps is then leading to folks misinterpreting what the actual meaning of those numbers and the relevance of those numbers are. And so we want to remove that possible source of misinformation or misinterpretation, I should say. And we firmly believe that for those of you who are attempting to proactively manage your financial obligations to CalPERS, either with additional payments or changes in your amortization schedule, or putting some money into a 115 trust, all those things are important for you to consider in line with your own specific objectives, right? It's the same activities for one agency might not be best for another, but in looking at that process of trying to maximize your objectives through financial management of these plans, we just think you're going to have an easier time when you see these numbers combined. Next slide. Okay, so if things in general are better for you to see combined, why would we keep the normal costs percentages separate? Well, unlike some other numbers in the report, the normal cost percentages are based on only people within that benefit tier or that benefit formula. So if you have let's say a 3 at 50 tier, the normal cost percentage you'll see in your report for that group only reflects people that have that formula. It's a very accurate depiction of the expected annual cost for being in that benefit tier. Now, we could blend those percentages also and show you just one percentage going forward. We actually do that for the non-pooled plans, but we believe the drawback to doing that is that what we're doing now with regard to normal cost is actually a more precise way to accurately fund the benefits as they're accruing, because if we were to blend them on the valuation date and show you one normal cost, and then have you make that on the individual payrolls of your benefit tiers during the year where those contributions are due, the mix of those people within those tiers is likely going to be different. And so that average or blended normal cost is generally not going to be as accurate as applying the three distinct normal costs to the three levels of payroll. Next slide. Now, let's talk about assets. This is the one number within these reports that we would like to eliminate showing you, and there are valid reasons in doing that. And of course, there are items that flow from having an asset number, such as your unfunded liability, funded status of a group, or a specific payment towards a specific unfunded liability. So without providing assets broken down by benefit tier, we're also not going to be giving you any of these items as well. And the main reasons is that, and I think I mentioned this, the current allocations of assets by benefit tier have no meaningful impact on the funding of the plans, financial reporting, or the benefit security of the members in the tiers. And it also, as I've mentioned, it's very possible when you see an asset number attached to a benefit tier that you may interpret that as having some meaning that it really doesn't have, and we want to avoid that going forward. Next slide. Okay, so I promised a deep dive into assets. So let's move forward. So here in this table, we're talking about various aspects of asset values that you would see in a valuation report. And I want to start with what you would see in a non-pooled report, even though that's not what we're talking about today. I think when you look at what these numbers mean in a non-pooled report, it's probably sort of intuitively what you would have expected, right? It's a fund balance on a particular measurement date, no different than sort of a pot of money that is designated for this employer and designated to pay the benefits of only this employer. You can calculate that value on any particular date by reflecting contributions into that fund, subtracting benefit payments that have come out, and adjusting for any investment return that those assets may have earned. No different than balancing your checking account, right? You can get from one number to the next in that fashion. These are values that are calculated directly by our financial office, not the actuarial office. There's nothing with regard to what's happened with the pool in total or the group in total that would affect these numbers. In fact, they're one of the first items that we have available to us when we start doing a valuation. We're probably very close to already having the 6/30/2024 asset values for our non-pooled plans before we've really even begun the valuation process. Now, so very much probably what you would have anticipated. But if we now look at what those numbers mean and how they're calculated in a pooled environment, the main difference is it really isn't a pot of money that's earmarked for that agency and earmarked to pay specifically the benefits of that agency. And it doesn't track from one period to the next. Some of you may have noticed that, some of you maybe haven't, but if you take the asset value from your prior year's report and attempt to match your current year by adding in the contributions you've made, subtracting out benefit payments, adding investment return, it does not track that way. There's a reallocation of these asset values within the pool every year, and it has some reliance on just what happens with the pool overall. I would tend to consider it more so than a pot of money. I would consider it more the funded portion of your accrued liability. That would be the way I would think about it in my head. And in fact, the way we calculate it is a little bit backwards from what we do for the non-pooled plans. We actually directly calculate your agency's unfunded liability first, and then sort of back into the asset number by subtracting the unfunded liability from the accrued liability. Next slide. So first of all, we understand that's a lot to wrap your head around, perhaps, and hopefully my explanation helped a little bit. Our actuaries are always available for follow-up questions, and we are going to be attempting to do more stakeholder outreach on this going forward. So there will be other opportunities for you to hear more about some of these things and ask more questions. But while we're on the asset topic, I want to mention two other related topics. And the first is if an agency decides to terminate their contract with CalPERS. Now, this is something that doesn't happen all the time, doesn't happen very often at all, but occasionally it does happen. And even more rare, within those terminations, if the agency is unable to contribute to CalPERS what we calculate as the unfunded termination liability, in those unfortunate cases, there sometimes needs to be reductions to the benefits that members are able to receive. Now, it's only happened a handful of times that I'm aware of. It's a very unfortunate situation. CalPERS is just following the law in those situations. We don't have any other option other than to reduce those benefits in that case. And so if we go to the next slide, what we want to show you with an example is that it doesn't, in that case, it doesn't matter. Can you go one more slide? It doesn't matter how well funded any of these individual groups are on the termination date. So this is an actual CalPERS agency who is getting 3 reports and saw in their last report a percentage funded of termination liability for each of these 3 categories. And those ranged from 51.2% to 98.7%. And seeing those, it would be natural maybe to think that upon a termination, perhaps my PEPRA members would come out better than my classic members, given this breakdown of assets. But the law would require us to combine those assets together, the liabilities together. In this particular example, this group of plans is 52.8% funded on a termination basis. If they were to terminate and if they couldn't chip away at that termination liability, every member in all of these plans would get a 47.2% reduction in their benefits. Now, again, this is very rare. This is not meant to, to scare anybody about benefit security. It's just an example of how you may have seen an asset number in a previous report and interpreted it to mean something that it doesn't in a particular situation. Next slide. The other item I want to talk about in connection with assets, and this doesn't support the argument for combining plans or keeping them separate, but we know a lot of you have made additional discretionary payments over the years. And because you're getting separate reports for these separate benefit tiers, you've directed a certain amount of money into specific benefit tiers. So maybe you called your actuary, you wanted to give us an extra $1 million, and you wanted to go to your PEPRA group. And that's where we placed it, and that's where it showed up in your PEPRA standalone valuation. And the only point we want to make here is that once we combine these plans, we will be combining the assets of all the plans. Every additional payment that you've made, regardless of where you earmarked it for previously, will be totaled together and will be part of your total asset number. You won't have lost $1 or gained $1 in this transaction. We will exactly preserve any additional payments that you've given us in the past. Next slide. Okay, so now we want to shift gears a little bit and talk about why it's important to see the big picture. Now, there's a quote that many of you have probably heard. It goes something like, "Can't see the forest for the trees." I'm guessing many of you have heard that. And I just looked it up the other day to see what kind of description I would find with regard to that saying. And it went something like, "Parts are distracting you from comprehending the whole." I have that written down. I had to look, sorry. "Parts are distracting you from comprehending the whole." And I think that's a great way to describe that saying. And it's also a perfect analogy in this situation. We believe, and we're going to try to illustrate in these coming slides, that when you see some of this information broken down by benefit tier, it's not as helpful or valuable to you when you're doing things like trying to assess how the funding policies are working for your plans. Why are your contributions at the level that they're at? What might you expect with regard to future contributions going forward? There's a lot of items in your valuation reports to try to give you a good picture of those things. And yes, you can do it by managing those groups separately, but it takes a real deep dive into everything within those reports and probably discussions with your actuary to be able to figure out how each of those are moving and possibly going to move going forward separately than how they will move as a whole. Next slide. So just to try to get a sense of why this is, I wanted to show you a few slides here, which now these are theoretical groups of members. And here we have a chart of a theoretical classic group. And we're just showing you how numbers progress over several decades of time here. And of course, these are what we call closed groups, because if a member in your classic group leaves and you replace them with another person, they're going to go in the PEPRA tier, not the classic tier. And because of that, there's a certain way that all these valuation results are expected to move. For example, the pinkish line, which is payroll, appears to be somewhat steady for several years before it starts declining, and then it declines fairly rapidly, at least in terms of the time horizon of a retirement system. Eventually, it's going to go down to zero when the last classic person terminates. Now, the benefit payments for this group move completely differently. They are continuing to increase and will continue to increase for quite some time as more active members retire and start joining the group of people who are getting payments. Now, eventually, later enough, and you can probably see it a little bit at the end of this chart, those benefit payments will start to decline and will also go down to zero, 60, 70 years from now when the last person has died. Now, with regard to accrued liabilities and assets, those are represented by the green and blue lines. You can see there's an increasing pattern for a while before it reaches sort of an inflection point where those numbers start to come down. Now, a couple comments with regard to this kind of a closed group. First of all, with regard to net cash flow, you consider the money coming in versus the benefits going out. You can see a huge disparity here. This, by the end of this projection period, there's a lot going out in terms of benefit payments, not very much, if anything, coming in with regard to contributions. And secondly, maybe not transparent by looking at the chart, but this group of people is going to be much more susceptible to large swings in their contribution rates going forward. And we're going to see some examples of that on some later slides. Next slide. Now, let's look at the corresponding PEPRA tier. This is a new tier of folks. We just started in 2013 to get members into these tiers. So things are starting slowly, building slowly. You can see, pretty consistent, but not too rapid increases in payroll and contributions. But the accrued liabilities, on the other hand, and the assets are increasing much faster than those other items. Now, we don't have a separate green and blue line here on this chart because this plan, this theoretical plan, is fully funded right now. And on a projection basis, if everything happens the way we expect, they're going to continue to be fully funded out into the future. And so they're both really represented by the same line. Now, why would a PEPRA plan tend to be fully funded, but a classic plan not? Well, generally, just due to the size of these plans, they're quite a bit smaller typically than the classic groups. And when you think about when a plan like this encounters some new unfunded liability, it generally takes a smaller dollar amount to get them back to being fully funded. And so whether it's through the normal, the way we set contribution requirements for your minimum payment, or whether as an employer, you've targeted these PEPRA groups and said, I want to keep these fully funded. It wasn't requiring maybe too large of a sum of money to do that. It was relatively easy maybe for you to keep those groups fully funded. But the point I would make is that you can see how fast this accrued liability, which is also a funding target, you can think of it that way, how fast that's going to build going forward. And while it's an admirable decision to want to keep that group fully funded, it really is not a very practical goal. These plans are going to eventually reach the size where in any one year, particularly where there's a dip in the market, it will be very tough, if not impossible, to continue to keep these fully funded. So now if we move forward, we're just going to glance at how these results look when we put them together. And I think what you'll see is, so can we go forward a slide? Thank you. Obviously, this is a smoother, more stable looking pattern of results. With results like this, it's just easier for us to see how the funding plan is working, how your results compare to other plans. You don't have factors competing in the opposite directions like you do for a closed classic plan and an open PEPRA plan. You now have a single entity, which is an open population, and it's much easier to understand conceptually when you see how the results look. Now, As we move forward, I can hear people saying, okay, I kind of see that with the shape of these charts, but I don't really get what you're saying, and I would need to see some numbers. Well, luckily, you've got the right person here to show you some actual numbers. So if we move forward a slide, what we're going to do now is take a look at some specific items within your reports. We're going to look at how they look separated by benefit tier versus how they look in total, and continue to make our case. And we'll start with required employer contributions. So next slide. This again is an actual CalPERS agency. They have 3 benefit tiers within their miscellaneous population, and they're receiving 3 individual reports. And at their last valuation date, they were given required contributions expressed as a percentage of payroll, as you can see on this particular slide. For the classic tier 1 group, their contribution requirement was 85% of payroll, 16% for their miscellaneous tier 2, and 11% for their PEPR group. Now, off the top, it's not obvious why there would be such a disparity between those 3 figures. Now, certainly the classic benefits tend to cost more than the PEPR benefits, but not enough to explain this kind of a difference, 11% versus 85%. Now, when they would see these numbers in total, which they will going forward, they would see in total their contribution is 47% of payroll. And it's just adding those 3 pieces together. It's not changing the required contribution for these 3 plans. It's just looking at them in total. Now, this number has a little bit more meaning, right? The cost of your benefits as a percentage of payroll is a very common number that's used within public sector retirement systems to give you some indication of how much do these benefits cost, maybe relative to other items in your budget, or perhaps relative to other CalPERS agencies, right? It's sometimes good to know how expensive are my benefits versus other plans within CalPERS, or maybe even outside of CalPERS, right? There are public plans all over the country, and sometimes it's just good to know how do the costs of my plans stack up globally, maybe. And so what you can do now with this number is you can see from our risk pool valuation that the average for an agency is a 23% of pay contribution. And so now what this tells me for this agency is, well, I'm much higher than the average miscellaneous agency, and I probably should know why. So that would be either something for you to figure out or to ask your actuary. And maybe there's action that you would like to take to see if you can bring that more in line with the average. Or maybe it's just circumstances that are out of your control, but you just need to understand why. Now, looking at the 3 separate percentages ranging from 11 to 85, you might not have really had a good feel for, am I paying more than the city next to me, for example. So again, a reason why we think seeing this information in total is going to be more helpful to you. And if we move to the next slide, there's another area within contributions that I think is important to mention. Now, this is a different sample agency, but it's an actual agency within CalPERS. And they happen to have one benefit tier that's overfunded. In other words, they have more assets allocated to them than liabilities, and one that's underfunded. And what happens in this case is they receive 2 separate reports. One of them says, well, you have no UAL payment required because you don't have any positive UAL. But in the second report, they're being asked to contribute $948 to go towards their positive unfunded liability for that benefit tier. Now, when we look at these plans in total, which we will do going forward, in total, these plans are overfunded. There would be no required UAL payment for this group of plans once we put them together. So that is a change to how a contribution might come out in any particular year. Now, I want to emphasize that it doesn't mean that necessarily you've been overcharged in the past, or that somehow you've made a contribution that you're not getting credit for. This particular agency is going to be required to make this contribution, but it's just going to add to their level of overfunding of the entire group of members, which will then be usable for them to offset future unfunded liability costs. Next slide. Okay, there's another contribution item that we show in all of the reports. Now, this isn't something that you have to make. But this is it's something called negative amortization. And what it means is that we've set your required contribution, but it just happens to be not large enough to result in a decrease in your unfunded liability. If that's the only contribution you make, and that's what we're requiring, we would expect your unfunded to actually grow because that contribution is not as large as the interest will be on your unfunded liability. So we just point that out in your valuations, and we tell you if you want to avoid that, if that's something that's important to you, you might want to make this additional contribution. And for 2 of these 3 plans, this is the information that showed up in their reports that you would need to make a $6,661 contribution to avoid negative amortization in your Tier 2 plan. Now, again, it's pretty simple to see that when we add all these together, the size of the UAL payment from the Tier 1 plan is large enough to avoid any negative amortization with regard to the total unfunded liability. So a situation like this, when we combine these plans, would show that your required contribution is more than enough for you to achieve positive amortization of your unfunded liability without making an additional payment. Next slide. Okay, funded status. This is one of the main measures of the health of a system. We use a lot of measures. This is our same sample agency, and you can see they would have seen 3 individual funded statuses for their 3 different benefit tiers. Again, probably not clear exactly why one's better funded than another, well, how well funded are my plans versus the average miscellaneous group within CalPERS. And again, just another example of when we look at the numbers in total, we're 67.5% funded, which is pretty well below, I would say, the average of the miscellaneous risk pool. It wouldn't have been obvious from looking at the 3 pieces that in total, these plans were worse funded on average. But again, this seems like information that the employer would want to know. What are the reasons for this? What if we want to somehow change this outcome going forward? Next slide. Okay, I'm going to talk really quickly about this. I see, we're getting close to our 45 minutes and I want to leave time for questions. But this is just another item in the report that I guess all I'll say about it at this point is that, well, this is an indication of how volatile your contributions may be going forward. And again, when you look at the individual numbers for each of the benefit tiers, they don't give you the same helpful information that I think they give you when you see them in total, particularly versus the average plan within CalPERS. As it turns out, this group of plans is much more susceptible to contribution volatility than the average plan. Probably not something they could figure out from the 3 individual pieces, but can easily identify that with the total. Next slide. Okay, impact on your procedures. Next slide. So you're likely to receive fewer reports under this process. Now, maybe you only had 1 benefit tier within your miscellaneous folks or within your safety folks, and you're not going to get a reduction in the number of reports, but the majority of you will see fewer reports going forward. You will still have an individual normal cost for each of your benefit tiers, but you'll have a single UAL payment for any of the groups that we've combined. Next slide. This is pretty much what it will look like in future reports. Now, this box has always been in your valuation report. I know for some of you, it might be the only page that you're really interested in. I understand how important this box is to our agencies. And the only difference you see here for this agency is that they happen to have 2 benefit tiers, a classic and a PEPRA. So we're going to show them those 2 individual normal costs, 27.39 and 14%. That is what they will actually pay on behalf of the payroll for those folks when those contributions are due 2 years after the valuation date. But now they will have a single UAL payment of $1,367,000. Next slide. And I think this slide goes along with the theme that we've tried to emphasize throughout this presentation. We encourage active management of these obligations to CalPERS, and we talk about that a lot. We have tools for that we try to provide to you. And what we've tried to argue with this presentation is that if you have specific objectives with regard to these plans, even beyond just securing the benefits for your members, we think you'll be able to achieve those objectives more easily when you see all these numbers combined. So you can still make ADPs, you can still fresh start your amortization schedules, you can still do some of the things you have been doing, but you'll be doing it with respect to a larger group where we've already combined these benefit tiers. Next slide. Okay, some quick final remarks. Let's move forward a slide. Okay, so we are planning to implement this for the June 30, 2024 valuations, which will be issued about a year from now. So it'll be a year before you would see a report that has these differences. And of course, these reports are going to set the required contribution for the year beginning 7/1/2026. And so there won't be any change to how you're making contributions until that date. We've talked about the issue with police and fire groups somewhat. And I'll just say again that we do consider those police and fire fairly different classifications of members. We expect that maybe you prefer to see those results separately. And so in general, we're not going to be combining those together unless you already have those different types of safety members combined, in which case we will combine at that point. Now, if you have any questions about which of your plans will be combined, you can always reach out to your actuary. And again, we will have other forms of stakeholder outreach as we move forward with this. It's not intended to change your long-term contribution effort to CalPERS. We saw an example of, in 1 year, a plan maybe was asked to make a $900 contribution where under this new approach, they wouldn't. But the long-term cost of your plans is not going to be impacted by this combination. In other words, whether that agency made that $900 or not, it either was made and offset their unfunded liability, or it wasn't made and they still have that $900 unfunded liability. So it's not changing the ultimate cost of the plans. There is no impact on financial reporting. The information that CalPERS supplies every year for the pooled plans to do your financial reporting has already been combined within the different classifications, miscellaneous and safety. Next slide. So we are looking for feedback. There are some ways we could adjust what we're doing with these reports in terms of how the reports look, what maybe is showed separately, what we don't want to show separately. We will take feedback into account, but if you wanted to request a certain item to be separate, let's say an asset number, which we don't plan to do, we certainly would like to hear your reasons for wanting that, what you're using that for, and maybe talk to you about why you probably can do without it, or if it's just purely for some internal purposes, you likely can do that split on your own in some fashion that would have the same value of us doing it. So we want to hear your feedback. There's a specific email address within our stakeholder relations group, which is on the next slide. Maybe you've used this email in the past, but any questions, any comments, any suggestions, anything you want to say at all about this process, we'd love to hear your feedback at this email. The stakeholder relations folks will make sure that the actuarial office gets these and someone can talk to you more about it. So with that, I think we've got 10 or so minutes left, maybe 12 minutes. Let's take some questions.
Great. Thanks so much, Randy. So the first question, I believe you touched on it, but just in case Jill didn't hear the response, it's, will you continue to show the UAL separate by plan? For example, the dollar amount of UAL associated with Classic and a separate dollar amount of UAL associated with PEPRA.
Yeah, we are not planning to provide those separately. You will see that as a total. And, you know, I know a lot of the math and the theory behind all of this, you know, can make your head spin. We have a lot of head spinning discussions in the actuarial office on this as well. But when it comes down to it, the fact that we're showing you a separation of that unfunded liability probably doesn't have the meaning associated to it that you think it might. In fact, any part of unfunded liability for any specific benefit tier has had some influence of the pool as a whole, right? So if you have a classic tier where we're showing an unfunded liability of $10 million, that doesn't mean that's attributable to those classic members or even just classic members in the risk pool. That number has been influenced by the entire pool, the way it's been allocated to you. So in a lot of respects, it's a bit arbitrary that we would separate that. And we think that there would be ways internally for you just to, for whatever your purpose is, you can probably do that separation on your own.
Okay, next question. Would the normal cost employer and employee contribution for each plan still be shown on the reports?
Yes, yes. So we do believe that's the one number that you're seeing separately for these benefit tiers that we want to continue providing you separately. And we want you to make your normal cost contributions on those individual percentages. That is just the more accurate way of funding the accrual of benefits in that year. Now, for non-pooled plans, we also do show those normal costs separated, just like we will do now for the pooled plans. But the difference for non-pooled plans is we actually do blend those normal cost percentages for what you use to make your normal cost contributions. And as I said, that might not be the most ideal process, and there's a possibility we'll revisit that for non-pooled plans and maybe change it going forward. But we will show you those percentages. We think they're important for you to have. They're a good measure of how much do these benefits cost versus these benefits. And so, yes, you will continue to see those separately. As well as payroll for those groups, you'll see separately. Active count for those groups, you'll see separately even in the combined reports.
Okay. Can you explain further how the UAL is determined for individual employers in the pooled plans?
Sure.
If not, oh, it's a link. It's a two-part question. Do you want to take that? Okay. The second part is, if not the same percent of employers AAL to total AAL, then how? Otherwise, wouldn't the funded ratio for all employers in the pooled plans be the same?
Yeah, so I don't have the same history as some of the other actuaries in the CalPERS office, but I want to say that maybe the funded status was the same across the pool, but don't quote me on that. That would go way back. But yeah, for right now, right, there's a different percentage of assets allocated versus your liability agency by agency. And part of the reason we like that is to allow you to make additional payments if you want to, if you have that extra money available. It is better for your plan, your members, and saves you money in the long run if you give us more money than you need to. So certainly we want that to be able to continue, except on a combined basis. And we want to be able to track that. So the more money you would give us, the higher your funded percentage would go. Now, the way you get new unfunded liability is by looking at the unexpected events during a year across the whole risk pool. Unexpected events meaning asset returns that are higher than or less than 6.8, more or less deaths than expected. Same goes for retirements or disability retirements. We would look at that across the entire risk pool, every member within that pool, and boil that down to a single new piece of UAL, actually two new pieces of UAL, one for investments, one for non-investments. And however big that is, now that is expected not to be all that big relative to the total, because this is a very large group of people that we are pretty good at predicting, at least year by year. So now we've got what should be a relatively small gain or loss, at least on the liability side, that we then just evenly allocate to all of you, all of your individual groups based on your current accrued liability. So you're taking what's hopefully a reasonably small additional piece of unfunded liability and spreading it evenly across the pool. So, and that's where I say, if you saw a UAL attached to a classic group, you may think, well, that either is based on my classic members' experience, or maybe the pool's classic member experience, but really it's a conglomeration of experience across the whole pool.
Okay.
Did I answer both parts?
I think so.
Okay.
All right, so we'll see if we have enough time for 2 questions, but looks like we have 2 in the queue. So why not just show the information in current reports and the better information in a single combined reports? Isn't more information better than less?
It's a very good question. And I think it all boils down to what I've tried to explain during the presentation is that even the presence of certain numbers provided in these reports, if it's not fully understood what that number means, how it was calculated, it can lead to some misunderstanding of what that number is. And we've tried to go through, for example, in a termination or in calculating your contribution requirements. Those allocations to those benefit tiers probably aren't representing what, broadly speaking, our agencies thought that they represented. And as actuaries, we have professional requirements to make sure that the information we present is not somehow misinterpreted or misused. That's a very basic tenet within the actuarial profession. And so something like an asset value for a benefit tier, the way that it's determined in the pooling process is likely not giving you the information that you think it is. And there's always the chance that the wrong thing will be thought about it or said about it to other interested parties. And so, yeah, there are some items that there's no problem showing them separated. The normal cost, payroll, average benefits. I mean, there's a number of things that there's no question that those are valid numbers. And if you ask for those, we will consider supplying those. But this asset number that you've seen, it doesn't, there's no reason for us to provide it from an actuarial standpoint, and there's more risk that it'll be misinterpreted or misused, I think, than any value of providing it to you.
Okay. So there's 2 questions, but one of the questions is in my closing remarks. Oh, it looks like Fritzy's typing an answer to the other question. So I think then I'll just go ahead and conclude. So as a reminder, this webinar was recorded and we will be posting it probably in about a week. It will be online on our YouTube channel. We will also email out to those that are on this webinar a copy of a link to the webinar so that you can view it later or share it with your colleagues if they have any questions. Oh, hold on, there's a question that came in. Says, as I'm listening to, oh, Fritzy's taking care of that one as well too. Wonderful, thank you, Fritzy. Anyways, like I said, so this webinar is being recorded and will be shared and available online afterwards. We really appreciate everyone taking the time to listen to these proposed changes that the actuaries are considering. As Randy shared, we do have the stakeholder mailbox that we are soliciting feedback for your concerns and feedback on these proposed changes. So if you have any information that you would like to share with us, please send it our way. And as we do have additional webinars or opportunities to share updates on this process, we will be sharing it with you as that information becomes available. So thank you again for your time, and we hope you have a wonderful day.